What's up everyone, it's Caddy with MoneyVest. So in this video, we are going to be talking about a brand new company, a brand new stock, a company that I've never analyzed on the channel. And this stock is absolutely insane. It is mind-blowing that it has gone up over 16 months in a row. This is what the chart basically looks like. So it is absolutely nuts how much it has gone up in the last 16 months, and it's gone up over 600%. If you know which stock I'm talking about, pause this video and comment down below. Not after you're done watching this video, right now. If you know which company we're talking about, and give you a little bit of a hint, we have never talked about this company on the channel before. A couple of people have talked about it in the live streams, but I've never covered it specifically. Let me know in the comment section down below. It is not a very popular stock. It is not a stock that most people are talking about. It is, a very, very small company as well, I would consider it, because it's only $7.4 billion market cap. So it's definitely a lot less compared to like the big techs, obviously, and some of the other companies that we talk about. So if you know which company it is, pause the video, comment down below, and don't forget to subscribe to the channel, drop a like as well while you're at it, and make sure that you do check out the links down below. We do have our sale right now going on for fundamental, technical analysis, options courses, 50% off, 60% off for the bundle, which is literally the best value bundle you can find. And the coupon code is going to be Labor4, and that will expire tonight. So after tonight, after Monday night, midnight, this will go away. So take advantage of it while it's still here, and you will get up to 60% off on the bundle. So the company that we are talking about today is going to be ELF Beauty. And this is the company here, ELF Beauty. Again, cosmetics, makeup, this is a massive industry, and it just continues to do really well. And they have consistently grown revenues, cash flows, earnings for a significant amount of quarters, and very, very consistent business. So this is the almost 600% rally, 16 months of consecutive gains, except for maybe 1 month here when it was down 1.3%. So far in the month of September, it is down over 1.25%, but nonetheless, it has seen nothing but an insane rally, trading at almost $140 per share. So ELF Beauty, obviously, they've got a lot of different brands. I'm sure, you have had some experience, or your significant other may have had some experience in their products. They are a pretty big cosmetic brand, and 18 consecutive quarters of net sales growth, right? So look at that. Look at those stellar numbers here. Just absolutely incredible. Every single quarter, they've been able to post growth on a year-over-year basis. And this is what's actually mind-blowing. They're one of the 5 public consumer companies out of 274 that has seen 18 quarters of more than 20% growth. 18 quarters divided by 4 is 4.5 years. So almost 5 years of growth of over 20%. Insane, right? I mean, the amount of people buy makeup is crazy. 76% growth in net sales, 280 basis point increase in gross margins, and 135% increase in adjusted EBITDA. So they obviously offer cosmetics, skincare products, and international sales as well. So out of 800 cosmetic brands, they're the only brand to deliver 18 quarters of share gains and market share gains as well, right? So not only growth of 20% or more, but also offering share gains in terms of the market that they operate in. International sales up 79% year over year. And these are the product portfolios and their market leadership in different sort of items, I guess. Brushes, they are number 1. Eyebrows, number 1. Setting spray, number 1. Multi-eye, we got eyelash curler, number 1. What am I talking about here? So we got eyeshadow, they're the second company in terms of market share. Concealer, number 2. Sponges, number 2. We got lip shine, number 2. Cosmetic applicator, eyelash treatment, all these. I mean, bottom line is they're number 1 or number 2 in these products that they sell. They got lots of brands that they basically operate in. Over 100% growth in digital consumption as well. I think they do market with a lot of TikTokers, a lot of people on social media to basically target their audience, which obviously are going to be women, girls, to basically buy these cosmetic products, skincare products, mascaras and whatnot, whatever things they are selling, obviously brushes and all those things. 3.9 million members, over 25% growth in the Beauty Squad loyalty program is what they offer. And just take a look at that consistency, right? $144 million growing to $578 million. And gross profit's gone from $66 million to over $390 million. And operating income has gone from just under $10 million to over $68 million. So very nice consistent growth here. Net income also gone from like 4.4 million in 2015 to over 61.5 million. They have been issuing a lot of shares, so that's a huge red flag in my opinion. They have been issuing shares left and right, and the actual share count increase is by about 23% every single year since 2016. That's insane, right? A lot of share dilution. 23% compounded annually every single year. That's a lot. And yet the stock price is still moving in the right direction. Free cash flow has gone from about 31 million to over $100 million in free cash flow. Pretty strong margins here. 68% gross margins. We got net margins of just under 15%. Free cash flow margins of just under 12%. Very nice, consistent return on common equity, assets, and capital as well. And take a look at this. ELF's 5-year average of net income divided by employee, $33,000, right? So in other words, their 5-year average, $33,000 of profit per employee. Guess where it is now? Almost $300,000. So that is huge in terms of efficiency and operating leverage. That's crazy. It's like 10 times increased compared to its 5-year average. So profitability has gone parabolic for the company. And not only that, they have been able to do that with a lot less employees on their payroll. Cash sitting at 142 million, debt's at just under 80 million, so they've got a negative net debt. That's fantastic. Current and quick ratio well over 2 and 3, and debt to free cash flow at 2.33. If it weren't for the share dilution, man, this would have been like an insane stock to be looking into in terms of its fair value. And of course, not to mention the valuation. So of course, when everything is working out, everything is good, it starts to become too good to be true, and there are no free lunches. And as a result, the valuation is through the roof, trading at 57, 58 times earnings multiple. Price to sales trading at over 9 to 10. And we got price to cash flow at a little bit over 78. So needless to say that it is a very, very expensive stock considering that it's trading at almost $140. This right here is going to be that growth rate for the company, which again, if accounted for, is going to be about 22% over the next couple of years. And free cash flow has grown by about 14%. So let's just dive right into our spreadsheet and do some calculations. I'm going to do an 18% growth in earnings, in net income over the next 5 years. I'm going to do about a 12% or a 14% growth in free cash flow. We're going to kind of assume a 20 times price earnings multiple and a 20 times free cash flow multiple. That's, again, a little bit more on the conservative side. Right now it's trading at 58. So you have to be prepared to better understand that fair value is going to be a lot lower than where it's trading at the moment. Discount rate 12% because they don't pay out any dividends. And then margin of safety of 10%. Share dilution definitely is going to be a lot because they have just gone crazy with share dilution over the years. So I'm going to keep it at 10% right now, give them a little bit of benefit of the doubt. And the fair value ends up, it's not even worth analyzing. Actually, you know what? I need to update the free cash flow here because it's not updated. Let me take a look. So free cash flow, that needs to be updated right now because it's not accounting for anything here. We're just going to do that. 2024, we're going to plug in this number over here. And 80 million, that's going to be growing at around 14% and 50% weighted average here. And here we go, $26 is going to be their intrinsic value. And the bottom line is that's probably because of the amount of share dilution and the valuation compression. Those are the two things, right? If I basically go with 0% share dilution and I go with about a P multiple of a little bit higher than where it's trading right now, it's obviously 50, 60 times. If I go with 24, you'll notice the fair value jumps to $50, and right now it's trading at 130, which still does warrant a pretty significant decline needed in order for this stock to be trading at its intrinsic value as we were to calculate it. So So that's where we are. I mean, I can even go as high as like 20, like I think 24 would be reasonable for the growth rate that they have. But share dilution, we have to account for that because the company has just been issuing shares left and right. So that is going to be definitely a problem. As you can come over here, take a look under statistics, annual. Every single year they've been issuing shares. So they've gone from like 45 million to 53 million, 54 million since 2016. So if you account for that since 2016, I don't know why it says on TradingView, that is strange. If you come back here, shares outstanding since 2016, 12.6 million to 56 million. And then 2017 says 49.4. So if you plug in 49.4, it's not that bad, right? It's actually closer to 2%. So if you do 2% over here in share dilution, then of course the fair value is still going to be at $45. So a lot of it has to do with price to earnings compression, the valuation. So again, if you come down here, 78 times, 11 times sales, 83 times cash flow. So that's where I would put down my fair value at around $45 to $50 per share. So this right here would be the flexibility range. And again, the main reason for this compression is the valuation, the price earnings multiple that it's trading at very, very high levels. And that's primarily because it's rallied over 600% since May of last year, right? Since May of last year, think about it, in just over a year, this stock's gone up 600%. So you can start to kind of think of how aggressive the valuation has increased, multiples have expanded for this company. So that's where we are. Again, this is only a $7.4 billion company. I mean, last year it was not even a $1 billion company or $2 billion company, and how quickly the market cap has grown for this business as they have continued to grow their market share, the revenue, the earnings. But be careful because this is just a very, very ripe for a sell-off. Of 30 to 40% drop here. I wouldn't be surprised if that ends up happening. And at that point, I'll definitely be looking into this stock in more detail. From a dollar cost averaging perspective, from a long-term perspective as well. So hope you guys enjoyed this video and a quick update on this company. Let me know your thoughts. Don't forget, we've got the coupon code LABOR4 available and active until tonight. 50 to 60% off on all of our courses. So link's going to be down below. As always, make sure that you drop a like, subscribe to the channel. Happy investing. I'll see you all in the next video.